Okay.
This is Rebecca with the Cat and Rebecca Show, Keep It Real Estate, and I'm with Brian and the Franklin Loan Center, Brian Kavanagh, and we're going to talk about what is exactly in a mortgage payment and what to expect. So we know we're going to have interest and principal. So what's that comes from?
That comes from the type of loan that you have, what the interest rate is, and amortized over however many years your loan's for. Typically 30. Most loans are for 30 years, not always.
So you're going to have a purchase price, and then you're going to have interest depending on how much of that purchase price is the loan.
So you have your purchase price minus your down payment, if there is one, leaves you your loan amount. Okay, and then your principal and interest payment will be based off of that loan amount, the type of loan you have with the interest rate, and the amount of years it's amortized for. You always hear 30-year fixed, so let's just assume that.
Okay.
So you have your principal and interest. We qualify you on more than just principal and interest, okay? You also have to take into account property taxes.
Okay, and
based on a monthly level. You have to qualify you on homeowner's insurance. That's fire insurance in case your house burns down, okay? And then possibly if there's any kind of association or homeowners association. Now, every one of those could be different for every house. Property taxes can be all over the place depending on the house that you buy, what kind of assessments are on that house. Insurance can be a wide variety of fee depending on the type of property, if there's ever been a claim on that house, and you yourselves, what you guys want for coverage. Association is depending on the area that you're buying on in that community, if they have specific association. Now, those extra items that are on there could be part of your monthly payment included with your mortgage, or you might be paying that on your own, but you will be paying those on a monthly level. Okay, so we look at all of that. So you might hear the term PITI. That stands for principal, interest, taxes, and insurance. So all of those are included. We always look at all of that when we give you quotes on what your payment will be. Okay.
now on the taxes, that's always a big question on my side, and I know there's usually an estimate that a lender will use. As an agent, it's my responsibility to kind of guide my buyer through what areas and where the taxes are, if they're higher or lower, so we know what kind of basic effect that's going to have on a loan if you're really tight on a loan. So you do use kind of an average on that, correct?
We use an average unless we have the actual location or address.
Correct.
Once we have that address, we can actually look it up, see what the assessed taxes are and what the assessment has been over the last few years to see what kind of taxes that we will have.
And again, your agent should be able to help you through that, because I'm usually pretty fairly knowledgeable in looking at that. And now the HOAs, again, is going to be unique. You'll know that up front when you go to a property. There should be some sort of notice that you'll know that there's a homeowners association associated to that property. Now, on the mortgage insurance, will all loans have mortgage insurance?
No, not all loans have mortgage insurance. Mortgage insurance is based on the type of loan that you have and how much money you put down. VA loans do not have mortgage insurance. It's one of the benefits of it being a veteran. FHA loans will have mortgage insurance, and they're going to have mortgage insurance in two ways. They have an upfront mortgage insurance, which is added onto the top of the loan. So it just adds on, and then you have a monthly mortgage insurance. And that is going to be one of two. It's either going to be 0.85% or 0.8%. Conventional loans is strictly going to be based on your down payment. If you do not put 20% or more down, you will have mortgage insurance, and it's going to be tiered on the amount of down payment you put and what your credit score is.
So this is the amount of risk the lender has, so you're paying insurance on that mortgage. So a homeowner's insurance is if that house has damage, fire, and so that's also going to be calculated in your homeowner's insurance.
Yes. And mortgage insurance, there's two different types of mortgage insurance. There's mortgage insurance premium, which is from FHA, or there's private mortgage insurance, which is for the conventional loans, Fannie and Freddie.
So those are the basics of what's going to go into that house payment. So on the next segment, I think we need to just talk about how much are the closing costs and down payments, and what could that look like. So till next time, this is Rebecca and Brian. Keep it real. Estate.